Definition of investment is investment can be viewed as sacrifice of present consumption in expectation for a handsome return to be repaid in the future. Foregoing the present consumption in expectation of having a greater consumption opportunity in the future. For the concept, it involves the purchase by an investor of an asset that will generate a certain amount of return proportional to the amount of risk assumed over a period of time.
There are two main types of investment, low risk and high risk investment. Low risk investment like bonds are safer because you lend money to reliable entities such as governments or corporations, which pay back with fixed interest, providing predictable returns. For example, government bonds are very safe, while corporate bonds offer higher interest with slightly more risk. On the other hand, high-risk investment like stocks can offer big profit but also riskier as their value fluctuates based on a company's performance. Growth stocks such as those from tech company can bring high returns but are more volatile, while emerging market stocks offer high growth potential but come with additional political and economic risks. There are three main investment objectives. First, capital appreciation is about growing your investment's value over time, ideal for long-term goals like retirement. It involves higher risk investment like stocks, mutual funds, and real estate with the potential for high rewards. Second, income generation. Focus on earning regular income such as through interest or dividends. This is great for covering expenses or supplementing your income, and typically involves moderate risk investment like bonds or dividend-paying stock. Third, capital preservation aims to protect your initial investment with low-risk option, ideal for short-term goals or those who prefer stability. This includes saving accounts, treasury bills, and money market funds, offering low rewards but also low risk.
For Chapter 2 Investment Alternative, I will explain about factor of risk in investment. There are various factors that could lead into this risk. The first risk is systematic risk and the second one is unsystematic risk. Systematic risk refers to external risk that could happen outside the organization and it is also uncontrollable. For example, inflation risk and political risk. Otherwise, it also refers to non-diversified risk which is unpredictable. For unsystematic risk, it refers to internal risk which is something we can manage such as financial risk or credit risk, and also it controllable. Otherwise, it also can be protected against diversification. The first sources of systematic risk is market risk. Market risk is possibility of loss or fluctuation due to stock price changes. How we want to reduce it? The first one by provide detailed consideration by examine price trend of particular stock or securities. For example, investor can employ hedge by examine historical stock performance during economic downturn. The second method to reduce is by choosing right time to invest using technical analysis chart. For example, by purchasing stock during prices are lower and selling stock before the market decline. The last method to reduce is by get ready for long-term holding of stock. How this strategy could be effective by investors should invest during economic downturns and focus on high-quality stock. The second sources of systematic risk is inflation risk. Inflation risk is referred to there is a degree of uncertainty to be received in the future. How we want to reduce it? The first one is by construct investment portfolio with a lot of cushion and introduce and venture or diversify into investment in real assets. By implementing these strategies, investors can ensure their portfolios remain resilient in the face of inflation. The third factors of systematic risk is interest rate risk. Interest rate risk, it refers in relation of variable interest rate that will affect the market value in the future. The method to reduce interest rate are by choosing short-term fixed securities, for example, treasury bills. Otherwise, the second method to reduce it by hold the securities until the maturity. This is because it will less exposed to the market fluctuation. As for unsystematic risk, it is due to credit risk. Credit risk, it refers to depends on financial health of the borrower. The method to reduce credit risk is by borrower provide guarantee to reduce risk of non-payment. For example, by third-party financial
I'm going to
backing.
explain the investment ecosystem, a network that connects investor, business and government to drive the global economy. We will explore its key components, how they interact and why they are critical for financial growth. So, what is the investment ecosystem? The investment ecosystem is a structured network involving participate, market and regulation. It facilitates the flow of funds between investors and those seeking capital, like business and government. In this ecosystem has three main components, which is financial market, regulatory bodies, investment intermediary. Alright, first we have financial market. These are platforms where financial instruments such as stock and bond are traded. They connect buyer and seller, enabling the transfer of funds. For example, stock exchange, where equity security, which is bond, are traded, for example, Bursa Malaysia. And last, money market, for short-term instrument like treasury bill. The second company is regulatory bodies. Their role is to oversee and enforce rules to ensure financial market operate fairly, transparently and efficiently. For example, Security Commission Malaysia, which supervises the Malaysia capital market, and next, Bank Negara Malaysia, which regulates Malaysia financial system and currency market. Alright, last, we have investment intermediaries who act as connector between investor and issuers of capital. They provide product and service to make investment activity more efficient. For example, broker like Maybank Investment Bank who facilitate the buying and selling of security. And last, fund manager who manage pool investment like mutual fund. Here how these components interact. Investor, whether individual or institution, already decide to invest. They often use intermediaries to access financial market. Regulatory bodies need to ensure this market are fair and transparent. The fund risk of flow to business or government needed capital. In return, investor receive profit based on the performance of their investment. So, this circle not only support economic growth but also benefit for all participate. To wrap up, the investment ecosystem is critical framework that drive the global economy. Financial market enable fund flow, regulatory bodies ensure fairness, and intermediaries connect investor with opportunities. Together, they create a sustainable financial system. So, I will pass to the next presenter.
Hello and Assalamualaikum. Welcome to this presentation on the securities market. Today we will explore how securities market works, the different types of market, key processes like IPOs, and the role of regulatory bodies like Bursa Malaysia and the Securities Commission. So, what is the security market? The securities market serves as a platform to connect buyers and sellers of financial assets. It consists of two primary types, which is primary market and secondary market, where primary market, new securities like share or bonds are issued for the first time, whereas the secondary market, which is where existing securities are traded between investors. Next, the primary markets enable company to raise capital through several methods, which is IPO, which is initial public offering, private placement, rights offering, sale to employees, and bonus issues. Furthermore, the secondary market. Secondary market is where securities previously issued in the primary market are traded. Platforms include main market for established companies and ACE market for startups and small businesses. Last but not least, the role of Bursa Malaysia. Bursa Malaysia acts as a central hub for trading securities. It provides a selling platform for buying and selling. Lastly, transactions and orders. There are various ways to trade securities, which is cash transactions, margin trading, and contra transaction.